Welcome to Close of Business. I'm Alicia Barry. The threat of Donald Trump's Liberation Day tariffs were on, then off, then back on again, all within a day. Now the uncertainty persists for investors second-guessing the impacts of future tariffs. For now, the tariffs stay in place. An appeals court has paused this week's decision by the Court of International Trade that found Trump didn't have the authority to impose the tariff regime. The White House was quick to trumpet the announcement.
The courts should have no role here. There is a troubling and dangerous trend of unelected judges inserting themselves into the presidential decision-making process.
The Trump administration has until June 9 to put its case. Multinational companies, including Birkenstock and Pandora, are looking to spread the cost of US tariffs by hiking prices around the world, just as the RBA has all but declared it's won the war on inflation. The latest print for April came in slightly hotter than expected, but it's still in line with the central bank's forecasts. Samuel Yang reports.
The sandals sold in this shop could soon cost more, catching some shoppers out.
Oh no, I would buy a pair right now before that happens.
To be honest, I don't think it's fair,
German shoe manufacturer Birkenstock is preparing to raise prices across the globe because of Donald Trump's trade policies.
For a full offset of tariff impact, we would need only a low single-digit price increase globally.
Birkenstock isn't the only multinational company considering price hikes. Danish jewelry maker Pandora is too.
If they impose all of the price increase on the US consumer, that could do a number of things, which is reduce demand significantly by the US consumer. It could also bring them some unwanted attention from the president, I would say. So they seem to be looking at spreading the cost.
I think as we get into June, July, August, you're going to see price increases around the world, anywhere from 3 to 5%, and on some products, potentially double digits.
Analysts are watching Apple and Samsung's next move. They've been threatened with US tariffs of 25% on phones not made in America.
If iPhones got built in the US, you'd be looking at iPhones in Australia that go up 3x from where they are today. It's not just about the US consumer, it's about the foundation of all the costs that are increasing around the world.
Something the Treasurer is mindful of.
The risk of higher prices and slowing growth are really among the key concerns we have for these decisions announced out of Washington, D.C.
Back home, consumer prices rose 2.4% in the year to April, driven by higher prices for holidays and food, in particular eggs, lamb, goat and fruit. Rent hikes eased while electricity and fuel prices went backwards. The RBA's preferred measure of underlying inflation ticked up to 2.8%, which is still within the central bank's target range. Economists say the central bank's next move on interest rates is just months away.
We think the next cut is in August, but there's certainly a big risk for a cut in July.
The Reserve Bank meets just before the US pause on reciprocal tariffs on more than 15 nations ends. While the central bank thinks the trade war will put downward pressure on inflation here, there are scenarios where it could push up prices.
There are possibilities that if this goes far enough and it impairs global supply chains, that could push inflation up here and everywhere else for a period. In Beijing.
The RBA Deputy Governor warns firms spreading costs worldwide could backfire.
Trying to insulate your US demand by putting prices up in other markets might be self-defeating because you might just end up killing your demand everywhere.
In Melbourne, this fabric manufacturer shares similar concerns.
The biggest worry for me is higher pricing will mean less demand, which means less requirements for product, which will definitely impact on future projections and buying.
ABMT exports a third of its products to the US, with fabric produced here and garments made in Vietnam and Bangladesh.
It's very hard to plan at the moment because the goalposts are moving so much. Everyone's scrambling to see what they can do to get around the tariff situation.
in a global economy weighed down by uncertainty.
The market reaction to the twists and turns in the Trump trade news flow has been pretty muted. But by the end of the week, the ASX 200 and the All Ords were up 0.9% each. Jun Bei Lui, founder at fund manager 10Cap, joined me. Jun Bei, there hasn't been any major market reactions to the latest developments in the tariff story from gold or the dollar or even US equities futures. Are investors just switching off to the news?
Look, absolutely. In a way, we kind of expect the court is not going to stop Trump. So something is going to go through. But right now, equity investors really had enough of all the news headline moves. And also, at the same time, we're kind of in that sweet spot where we still have a little bit of time left of the 90 days negotiating period, and we're not really receiving any other negative news headline. So investors sort of just taking a step back at the moment.
So how do you trade in this uncertain environment? What's the outlook?
Yeah, the outlook for the market actually doesn't look too bad because we certainly, as you said, the market is not really reacting to a lot of news flow now. So we think the peak uncertainty for the trade-related news is already done. So from here on, it's actually about fundamental, about finding good companies that's not being impacted by tariff, because tariff, we don't know what it looks like. But for companies, earnings continue to grow well, particularly here within Australia. We're not so much impacted. They will continue to do well.
There's a bit been written about the Australian dollar, which is typically a risk currency, being a beneficiary of this uncertainty and becoming a bit of a safe haven. Is it the same for Australian equities?
Absolutely. So we are actually seeing incredible amount of capital flow from offshore into Australia. It's partly because many investors or institutional investors feel US is no longer the core holding in their portfolio. They want to move some money out into the Europe and into Australia. Australia at the moment has been perceived as in somewhat insulated from tariff, and it's growing pretty well. It's already started its rate cut cycle, and our economic activity, our housing market is actually not too bad. It started to pick up. So, net it looks pretty strong for the foreign investors.
And the fact that the Australian dollar is fairly weak compared to the US dollar, is that helping?
Absolutely. We're seeing essentially foreign investors buying all the large caps. We're seeing huge amount of flow into the banks as well as into some of the healthcare space. Resources is the area where we don't see significant buying at this stage.
Now, another beneficiary of all of this uncertainty has been Bitcoin.
Absolutely. So Bitcoin has actually done incredibly well. But it's partly due to this, slightly improving risk appetite. And two is that essentially deregulation. This Bitcoin looks like it is going for a run for the next 12 months, just as the regulation becomes much easier for them.
On the economic front, at the end of the week, we saw retail sales out in Australia. It missed the mark in May.
That's right. Look, it is disappointing, but it is backward looking. So we already just had a rate cut. So market is taking the view that looking forward, things should get better.
And of course, we'll have the GDP figures out next Wednesday. Is that something the market will be focusing on?
Yes, market always get impacted somewhat, but it's not going to be long lasting. I think the expectations is it's going to be a little bit softer, but shouldn't be significant surprise to the market.
Jun Bei Lui, always good to talk to you. Thank you.
Thank you very much.
From F1 racing to aviation, businesses are increasingly looking to transition to sustainable fuels to position themselves for a net zero future. A domestic market would be worth billions of dollars, but experts warn the opportunity could pass us by. Tony Ibrahim reports.
We are all set on the grid here in Monte Carlo. It's lights out and away we go. Norris gets
the race is on to develop cleaner fuels. F1's turned the corner with a fuel change for next season.
Into the first turn.
We've got a great test bed in Formula 2 and Formula 3 that has been running 55% sustainable fuel over previous years, and this year is 100% sustainable fuel. And the drivers and the technical analysis shows zero drop in performance.
5 companies, many of them sponsors, will supply synthetic and biofuel to 11 teams on the grid.
You're racing green, you're providing a solution for the automotive sector and the wider consumer, but you're also giving the public and the fans what they want, and it will reduce greenhouse emissions by around 80%.
With Formula 1 in the driver's seat, companies are looking to Australia to make synthetic and biofuels that'll connect the cars, ships and planes of today to a net zero tomorrow.
So we estimate the market could be in the order of a $32 billion low carbon liquid fuels market by 2050 and a feedstock market of about $15 billion.
At least 2 companies are looking to build manufacturing facilities in Australia. Zero Petroleum is hoping to break ground in South Australia next year, while Porsche-backed HIF hopes a plant in Tasmania will be ready by 2030.
One of the main ingredients that we need is renewable energy. And Australia is well known globally for having a big renewable energy potential.
It would produce 500 times more synthetic fuel than this pilot plant in Chile, but the fuel isn't likely to make its way to petrol pumps.
These fuels and any kind of green product, you're probably talking 2 or 3 times the cost.
We need very low renewable energy costs in order to get that hydrogen price down. And then on the other flip side is the carbon dioxide that you need to source. And pulling that out of the atmosphere currently is technologically not as mature.
The latest government data shows less than 1% of registered vehicles are electric in Australia. The CSIRO estimates that'll grow to 97% by 2050.
There will be an existing fleet of internal combustion engines, we think, still operating at that point, and there needs to be a solution for those cars.
Governments and legislators should set targets to get to net zero and let the innovators, the technology providers find the solutions.
Synthetic and biofuels are currently being earmarked for heavy polluters like ships, trucks and planes.
By 2050, about 30 billion litres in Australia will likely be hard to electrify and will likely require low carbon liquid fuels or other decarbonisation technologies.
Qantas has just received nearly 2 million litres of biofuel. That's blended at a ratio of 18% with traditional jet fuel. It will reduce carbon emissions on 900 international flights by approximately 3,400 tonnes. But the airline had to buy it from Malaysia. The government is trying to jumpstart the domestic industry by offering $250 million in grants. But manufacturers want the same regulations that exist overseas, that are helping those markets grow.
Some of the mandates that are getting rolled out across Asia are in the order of 1% blend. It provides an investment signal back to the production side of the market to develop these facilities, and then in turn that brings down the cost.
Currently, our project is designed as an export project, and that's because there are other markets in the world that have more advanced regulation to support the uptake of these products.
Calls to get the policy settings right to put Australia in pole position.
Australia's biggest exports, iron ore, coal and gas, are under threat as the world decarbonises. That's the claim of the Superpower Institute, which has a plan to turn Australian ore into green iron, harnessing renewables. The Institute says if Australia can get it right, it's a $400 billion annual export opportunity. Rod Sims is the Superpower Institute's chair. Rod Sims, welcome to Close of Business.
Thank you, Alicia.
You say that there have been market failures holding investment back in green iron production. Was axing the carbon tax in Australia one of those failures?
No, it wasn't, because we're talking about an export industry here. So it's the price on carbon that you want at a world scale. It's a world price you need, not an Australian price. Now, there is a carbon price in Europe, pretty big country. There's a small one in China. They're moving towards them in other places, but they're not there yet. So we're saying, government, just fill that gap for a short while to make sure we get projects going in Australia and that we get them going quickly.
Your report models 5 locations where iron can be produced using renewables. What's the feasibility of this? I mean, are the big miners going to become manufacturers?
No, they're not. And that's the key point. You've put that very well. Miners are not manufacturers. No, the people who are going to do this are going to be the big iron and steel making companies in Northeast Asia. And obviously POSCO, I think Korea's largest iron and steel maker, has already expressed an interest. They've got a team here looking at it. One exception to miners not being manufacturers, of course, is Andrew Forrest has a pilot plant to make green iron, so he might be a candidate. But no, BHP and Rio, they're miners, they're not manufacturers.
And what's the time frame that we could see this in action?
Well, I think that the main message I'd like to convey is the package we've put up is all the government needs to do. There's people talking about this saying, oh, we've got to go overseas and get demand for green iron because there's a green premium. No, we've dealt with that by the $170 a tonne production credit. With that credit and with a bit of help on the capital side, which I've mentioned, Australian green iron can outcompete iron made with fossil fuel now. We've mentioned a number of locations where this can happen. The best two are the Eyre Peninsula in South Australia and Geraldton in Western Australia, but there's other places as well. So I would like the government to put in place this policy package very soon. If they were to do it in 2025, we would hope to have final investment decisions on projects by 2026, 2027.
Your report claims a green iron industry could abate emissions by more than 3 times Australia's yearly emissions. But is there a danger the approval of the extension of Woodside's North West Shelf project could undo that?
No, look, they're separate issues. So Australia, if it makes all the green energy intensive projects that it should, it could help the world reduce carbon emissions by up to 10% of emissions. Now, you might think that's a big role, but it's no different to the role we play as the world's biggest gas and coal exporter. So we're just substituting one fantastic advantage in gas and coal to the fantastic advantage we've got in solar and wind. So if the world's going to reduce emissions, it needs Australia. If Woodside want to make a bet that the world's not serious about reducing carbon emissions, they may be right, but it's a big bet. If the world's going to be serious about reducing carbon emissions and getting to net zero, you won't be using gas in 2070. So big bet by Woodside, big call, theirs to make. I assume, they're obviously factoring in that the world is not serious about moving to net zero. I think they're wrong, but they've made a different bet.
It was the Federal Environment Minister that approved it, though. Is the government making the wrong bet?
Look, it's very hard for the government to be fair, and different people have different views on what the government could or should do, what the government powers are. My bigger point is that when companies do a massive investment like Woodside want to do, planning on the world wanting a hell of a lot of gas in 2060 and 2070, they're making a big bet against the climate science, against the world moving to net zero. And my guess is it's going to cost them a lot of money because they'll get that bet wrong. I could be wrong, but in any event, if I could make a key point, Australia is a big exporter of coal, gas, iron ore. You can replace all those exports with green iron. So don't have all your eggs in one basket.
And have you got the ear of the government on this?
They're certainly listening. We had many government ministerial advisors and very senior public servants to our launch on Monday. They're well aware of the arguments. We talk to them a lot. Look, my guess is that the public service at senior levels understands what we're saying and has a lot of sympathy for it. Let's hope they can get the politicians over the line. That's what we've really got to do. And as I say, I think it's a real winner. I can't actually see the political downside to doing this, so I can't see why they wouldn't get right behind this.
Rod Sims, thank you so much.
Thank you.
Telstra's chief executive has responded to customer concerns aired on The Business that the telco has misled consumers over its mobile coverage. Speaking at an investor briefing in Sydney, Vicky Brady said customers who aren't satisfied with Telstra are free to switch to a different provider. Meanwhile, there are new calls for the consumer watchdog to take action, as Rihanna Whitson reports.
This is an inner-city suburb of Sydney, but you wouldn't know it going by the mobile phone coverage here.
I have to use WhatsApp to make phone calls and the phone cuts out with no warning, so I have to keep on calling people back. I sometimes think I'm living in a third world city.
The reception is so bad we had to interview this Telstra customer on the phone outside his home.
I would invite the CEO to come to my place here and see for himself. Yeah, it's disgraceful. I'm embarrassed to be here now talking about it.
It's been a bad week for Telstra after the telco was accused by rival Vodafone of inflating the size of its mobile coverage area. At an Investor Day, the telco's boss was on a PR offensive.
We keep delivering more for customers.
After announcing new price hikes for customers, she also doubled down on the extent of its mobile coverage area.
We have 3 million square kilometres of coverage. That does not require you to have an external antenna.
Telstra's decision to stick by its original claim about its mobile coverage size has puzzled industry observers. It also comes after the telco admitted it had changed its own website after being contacted by Vodafone to add the clarification that customers may need to use an external antenna.
If you look at what the Telstra CEO has said, and if you look at their website, you would be very confused.
Telstra's online map still says its coverage depends on the type of mobile device used and external antennas.
This potentially could open Telstra up to very large fines. Now, unfortunately, I wouldn't hold my breath because the regulators, both the ACMA and the ACCC, have taken a soft touch to regulations and penalties.
Hey, I'm just looking at a case for a test down in Melbourne. Yep. Were you able to get onto her on the phone?
Yeah, that's right.
This consumer advocacy platform has received 500 complaints about Telstra in 2 years.
1 in 3 of them related to issues with network and coverage. On top of that, just this year we've seen 10 times as many consumers visiting our website for help with Telstra issues.
I'm not looking for compensation. I just want my phone to work inside my house.
Tony is one of them.
I travel to Southeast Asia and everywhere I go, everything works fine. And these are poor countries that I travel to. And this is not good enough for Australia.
Look, I think that goes...
Back at Telstra's Investor Day, Vicky Brady had a message for unhappy customers like him.
If the experience isn't what they are expecting, they do have a choice, they can move.
Now that's customer service.
It's fast approaching tax time with just over a month to go until early birds can file their returns. But be warned, the ATO is on the lookout for private expenses being claimed as work-related items or donations. With more, here's Nasim Kadem.
It's one of our most hated to do items, along with going to our dentist. But tax time is here again. Each year, about 9 million Australians claim about $28 billion worth of work-related expenses. Many relate to working from home. The average claim last financial year was about $3,000. I'm here at the ATO and I'm going to be talking to Assistant Commissioner Rob Thompson about the do's and don'ts of claiming. Rob.
Hi, Nasim.
Good to see you again.
Good to see you.
So tell me, this year, what are you looking for most when people file their tax returns?
So this year we're focused on 3 things: work-related expenses, working from home deductions, and omitted incomes.
And sometimes when people do lodge, you still see some outrageous claims. Tell me about some of those.
So we do see some funny claims. We had someone this year who tried to claim their engagement ring as a donation on their tax return. We had a company director claim their treadmill, juicer, coffee machine, I think their gaming console and a bunch of other stuff as working from home expenses. Now, in both of those, they're private in nature and you can't claim them on your tax return.
Last financial year, 4 million Australians claimed work from home expenses. Why is it such a big number and what are you looking for this tax time?
There's some record keeping that you need to have. So whether you're using the fixed rate method, which allows you to claim 70 cents for every hour you work from home, or using the actual cost method, which is a little bit more complicated, just making sure you've got the right records.
And in terms of work expenses, one of the biggest items you see every year is car expenses. What are you you looking out for here?
So motor vehicles this year, there's two methods that people can use. There's the logbook method or there's the fixed rate method, which allows you to claim 88 cents for every work kilometre you travel up to 5,000 kilometres. Now, that's an all-inclusive method, so that includes all your motor vehicle expenses, including rego and insurance. But what we do see is people still claiming those expenses separately on the tax return, so just no double dipping there, making sure that they don't claim them separately if they're using that method.
1.7 million individual investors claimed rental deductions. What are you looking for here?
One of the main areas we continue to see mistakes being made is with respect to loans. So people will be using a mixed loan. So they'll take out a loan, they'll use part of it for their investment property and part of it for a private purpose, such as going on a holiday, buying a car. Just reminding people that they can only claim the interest related to the income they generate from the property, and they need to apportion the interest expense between the income bit for the property and any private expenditure there, and they need to do that for the life of the loan, just not once they've paid off the capital that might have related to the car they've purchased.
And again, are you seeing any really outrageous claims in the rental space?
Well, we do see some. For example, we did see someone claim a property manager expense when they didn't have a property manager. So obviously you have to incur the expense to be able to claim it.
What about crypto? Hundreds of thousands of Australians buy or sell crypto every year. What's your message to the crypto community?
You do need to include the gain or the loss on your tax return. Now, for most investors, that is a capital gain or a capital loss, but just a reminder to keep good records, both when you're purchasing the crypto and then when you sell it.
You've long used pre-filling and data matching for checking people when they file their tax returns. Just tell me a little bit about the discrepancies you're seeing.
So last year we pre-filled about 111 million bits of information into people's tax return for them to help them get it right the first time they lodged. So when someone's lodging, if something doesn't look right, like, a journalist is starting to claim a power drill or something like that, we'll ask them to look at their claims and just nudge them to check it while they're lodging their tax return.
Any final messages, Rob?
Not lodge too early. Wait until the end of July to lodge a tax return. We'll have pre-filled a lot of information into your return for you. Makes it easier to get it right the first time.
Thanks for your tax time tips, Rob.
Thanks, Nassim.
And that's all from Close of Business. For more on those stories, you can go to our website and catch The Business Monday to Thursday evenings at 8:45 Eastern on the ABC News channel and after the late news on ABC TV. I'm Alicia Barry. Thanks for watching.